Ethereum is coiled, compressed, and building pressure that could unleash one of the most explosive moves we've seen this year. Welcome back to Crypto Trading Mastery. Today, we're breaking down Ethereum with our full 6-pillar framework, and by the end of this video, you'll know exactly which price levels to watch and what the market is quietly telling us right now. For those watching for the first time, welcome. Here's how we approach every analysis. We work through 6 pillars: position, pattern, price, momentum, volume and volatility, and time. All of it sits within a macro outlook that incorporates correlated markets. It keeps our analysis balanced, objective, and, most importantly, actionable. Let's get into it. The first thing you need to understand is the structure we're trapped inside, what we call a dominant range. A dominant range is a price zone that encapsulates all subsequent price action. Every single bar since mid-April has been contained within it. No breakout, no escape, just compression. Here's the range. The low came in on April 13th at $2,176, and the high on April 17th at $2,464. That's our cage right now. So, how do we navigate it? We use the midpoint, $2,320, as our battlefield line. Above it, and the bulls are asserting control. Below it, and the bears are calling the shots. It's as simple as that. Now let's layer in our Fibonacci levels, because this is where the market tends to react. On the downside, we have a Fibonacci support zone sitting comfortably within the dominant range between $2,204 and $2,215. That's your floor to watch. On the upside, the Fibonacci resistance zone actually breaks out of the dominant range, sitting between $2,572 and $2,582, extending up to $2,614. That level is critical. Here's why. Ethereum started its descent from a high of $3,397 on January 14th, but it was the secondary high on January 28th at $3,401 that really accelerated the sell-off, and it happened so fast the market couldn't form any meaningful support zones on the way down. What does that mean for us now? It means that if price breaks through that Fibonacci resistance zone, there is nothing standing in the way. No supply, no barriers. Price could snap upward to fill that gap all the way back to the January 28th high. And if buyers have enough conviction, we could even see a challenge of the structural high at $3,397. This is the kind of move that triggers FOMO, buyers jumping in for fear of missing out, which only accelerates the move further. One more thing for the eagle-eyed viewers. Notice that the January 28th high and the 2025 anchored VWAP converge around $2,920 to $3,041, roughly a $100 spread. That zone will be a significant test if and when we get there. Now let's talk about volume, specifically the 2026 anchored VWAP, which represents the average price traded for the entire year. Right now, it's sitting directly in the middle of price action. Think of it like a magnet. When price is glued to the VWAP, the market is in a state of indecision. Neither buyers nor sellers have the conviction to push away from it. Until one side steps up, this tug-of-war continues. Now here's where it gets really interesting. Both our volatility and volume indicators are showing extreme compression right now. Think of it like this: toddler steps versus giant strides. Small, tight ranges mean toddler steps, contained, cautious. But expanding ranges, those are giant strides, strength and momentum behind every move. Right now, we're firmly in toddler step territory. And look at the monthly ranges: $1,150, $719, $413, $444. That's a pattern of contraction. The market is coiling tighter with each passing month. Here's the thing about compression: it cannot last forever, and the more violently it compresses, the more violent the eventual breakout will be. This is a spring being wound tighter and tighter. We also track a proprietary metric called close strength, essentially, where did price close within its full range for the period. Think of it like a ladder. A low reading means price closed near the bottom of the ladder, sellers in control. A high reading means price closed near the top, buyers dominant. Here's what the monthly data is showing us. From July through January, sellers were progressively tightening their grip, but from February this year, something shifted. Buyers started chipping away, reclaiming ground, month by month. At 54% close strength currently, buyers have a slight edge, but it's essentially a coin flip. The story is still being written. And one important caveat, May has only just begun, so that reading won't carry real weight until we're mid to late month. What is significant is the U-shape we're seeing across this data. Sellers peaked in control around January, and since February, the narrative has been quietly changing in the bulls' favor. Our proprietary momentum indicator issued its last buy signal on April 7th, with the trigger confirming on April 11th when price swung higher. That trade is still active. Now, important context. Zoom out to the weekly chart and we are still in a confirmed downtrend. What we're experiencing on the daily time frame is a rally within that downtrend. There is an unfilled price gap above that could push markets higher, but even filling it would not, by itself, reverse the broader downtrend structure. Trade the levels, respect the trend. Don't get swept up in the narrative. So, let's bring it all together. Here are your key levels for Ethereum. Watch the dominant range boundaries, $2,176 on the downside, $2,464 on the upside. A confirmed break of either sets the next direction. Watch the Fibonacci zones, support at $2,204 to $2,215, resistance at $2,572 to $2,582, extending up to $2,614. These are your signposts. Stick to them and you'll stay on the right side of the market. If you found this breakdown valuable, subscribe to Crypto Trading Mastery. We publish daily Bitcoin and crypto analysis to keep you ahead of every major move. Hit the notification bell so you never miss an update. And before you go, join our free daily crypto trading newsletter, 5 minutes every morning. The link is above and in the description. We'll see you in the next one. Take care.